Compiling the lease inventory is by far the most time-consuming and resource-intensive part of the transition to the new lease accounting standards. But by breaking the task up into smaller, more manageable steps, using our resources and following some simple tips learned from our prior transitions, the process becomes more manageable. We'll spend the next several slides reviewing the steps to gather your lease portfolio. To create a complete inventory of all your organization's leases, obtain listings of all leased assets from entities, subsidiaries, departments, locations, however your organization is divided. Obtain a listing of recurring payments from accounts payable, and then obtain copies of all contracts, again, from all your entities, subsidiaries, departments, locations. Evaluate all the contracts you've received to determine whether or not they are in scope, and then set a materiality threshold. We've got some questions about that, so we'll go over that in a minute. And then ensure all your appropriate contracts are included in your inventory listing. And finally, communicate your preliminary conclusions, critical accounting estimates, and policies with your auditors. The first step in gathering a complete listing of your leases is to reach out to all your subsidiaries, locations, branches, however your company is organized, and ask them for a listing of all their leased assets and physical or electronic copies of their contracts. Some tips we have found to make this step successful is start educating all those involved about the changes to lease accounting, what the criteria for leases are, what an embedded lease is, etc. Look at your requisition process. Which departments are involved with reviewing and approving a new contract? IT, legal, accounts payable. Those are the departments you will want to start with for your lease inventory. Ask for a listing of all the resources, leased assets, and then copies of all their contracts. Make sure to ask for contract copies and not just lease copies. If you ask for copies of leases, some contracts with embedded leases may be overlooked, so better to look through all the contracts yourself or whoever is leading the accounting project. Excuse me. Also obtain a listing of recurring payments from accounts payable. Identify what your periodic payments are for. Are there recurring payments you are making for the use of an asset, or any recurring payments you're not sure what they're for? Obtain copies of these invoices and the related contracts to determine if they belong in your lease listing. When asking all of your departments, locations, subsidiaries to provide a listing of their leased assets, it's a good idea to provide a spreadsheet with information you require already created, so all I have to do is fill it in. If the information is received in the same format from each source, it will be easy to combine and filter or analyze to see if there are any duplicates or line items you have questions about. I mentioned embedded leases a few slides ago. An embedded lease is a lease within a contract that does not call itself a lease. Embedded leases meet the same criteria as a lease under ASC 842. There must be an identified asset, and the customer lessee must have the right to control the use of that asset. Some examples are security or IT contracts where you pay for the services, but as part of that service, you also receive an asset such as security monitoring equipment or hardware, IT hardware. Another example of an embedded lease is a supply contract where you pay for the supplies consumed, but the supplies are dispensed from some type of equipment like a vending machine or automated dispensing machine for medicine that you don't pay for. And then a third example I know that we ran across at my entity was we had a rental agreement for some warehouse space, which generally would just be warehouse, which you wouldn't treat as a lease. I mean, we're not treating it as a lease, but when we drilled down more into the contract, we discovered that the space was defined as a specific piece of square footage within the factory and specific shelves. And so we met the criteria for ASC 840, well, IFRS 16, excuse me. We met the criteria for an embedded lease instead of just, the service of renting space. When you're reviewing your contracts to determine whether they are in scope for ASC 842, it may be helpful to develop a checklist with some of the scoped out agreements like intangible and biological assets or inventory, and also a checklist of the criteria for identifying whether or not a contract contains a lease, such as type of contract, identifiable asset, control, and use. To help you get you started, check out our embedded lease test. We'll drop in a link to the chat, and it's also on this slide. To take the test, you answer a series of yes or no questions about an agreement, and the test will email you whether you have an embedded lease or not based on your answers. So first, you give your contract a name. Then move on to the identification criteria. Is the asset specified explicitly? In our case, it was an exact shelves and square footage or corner of the warehouse as opposed to just any amount of space. Does the supplier have substitution rights? For our case of the warehouse square footage, they were not able to give us a different piece of the warehouse. It was only that square piece. There was no substitution between like. And then the final question related to identification criteria is the asset physically distinct. From identification criteria, you move on to control. Does the lessee have the right to the economic benefit of the asset? And then do you have the right to direct the use of the asset? These are the questions that need to be determined, evaluated to determine whether or not you have a lease and can help you identify embedded leases. So the last step here, you provide your email to get the results sent directly to you. And this would also give you information about all your answers, so you would have it all in one place. When gathering all of your contracts for your lease portfolio and determining which contracts are in scope, you also want to think about setting a materiality threshold. You may adopt a reasonable capitalization threshold below which right-of-use assets and lease liabilities will not be recognized on the balance sheet, similar to your asset capitalization threshold, but this should be determined independently of your asset capitalization threshold based on the facts and circumstances of your lease portfolio and its impact to your operations. Choosing to establish a materiality threshold early in the transition process will allow you to limit the amount of resources spent on low dollar value and low impact leases. When you believe you've compiled your complete listing of leases, there are a couple of ways you can ensure all your lease contracts are included in your lease portfolio. Compare and reconcile your physical or electronic or actual contract copies with the leased asset listings obtained from all your separate sources. Do you have a contract for each listed asset, or are some missing, either some assets or some contract copies? Compare your final lease listing with the 5-year lease commitment schedule you prepare annually for your financial reporting. If you prepare one, does your lease inventory reflect all of the leases on this schedule? Lastly, you can analyze your rent expense to see if any contracts may be missing. Extrapolate the annual rent expense from your final lease listing using the payment information from the contracts. Reconcile that amount to the total annual rent expense from all your rent accounts. Is your total actual rent expense larger than the extrapolated amount? This may indicate that you haven't included all your rental agreements in your lease listing. Are there some leases that still need to be added to your lease listing? In other words, you're paying for rent for agreements that may not have ended up in your lease portfolio. On the other side, if the annual extrapolated rent amount is larger than your total actual rent expense, this could indicate that you found a significant amount of embedded leases. Is that the case? Can you verify that as one way to reconcile what leases you've identified. And then one last tip, just be aware, these amounts don't necessarily need to reconcile exactly, but reconciling them directionally or in the ballpark can give you a sense of whether or not you have included all your leases. And this may be a step your auditors take for their testing, so knowing the results ahead of time can't hurt. The final step to gathering your lease portfolio is to communicate any preliminary conclusions, critical accounting estimates, or policies with your auditors. If you established a materiality threshold, share how you came to that conclusion. If you made any assumptions or estimates while compiling your inventory, provide support for those. Additionally, if you elected to use any of the practical expedients available for a transition, this is a policy election and also should be communicated. Practical expedients are elections allowed within the guidance to make adoption of the guidance easier. The ones you're most likely to hear about are the package of practical expedients. These are 3 expedients for transition that must be elected all together in a package. They are 1, electing not to reevaluate your contracts for a lease. 2, electing not to reevaluate the lease classification you determined under ASC 840. And 3, electing not to revisit initial direct costs identified under ASC 840. Again, these must all be elected as a package, and the package must be applied entity-wide as a policy, not to specific leases or specific types of leases. The one last item to note with these practical expedients is it is not permission to grandfather in any errors made under ASC 840. Said another way, if you missed identifying a significant embedded lease under ASC 840, it should be recorded under ASC 840 prior to transition to 842 to prevent an error in 842. Another practical expedient to consider is combining your lease and non-lease components. This does not have to be a company-wide policy, but can be applied by class of underlying asset. The implications of electing this expedient are that electing will prevent your organization from having to perform analysis on each contract. However, election could also cause the lease liability to be higher, which may in turn impact your lease classification. The last practical expedient I'll mention, though these are definitely not the only ones, and for a more complete listing, we have a blog about the practical expedients. I think, Jessica, if you could drop that in the chat. You can elect to keep short-term leases off the balance sheet. However, this is not to say that short-term leases don't have to be accounted for under ASC 842. They are still required to be disclosed, and you will still need to calculate them under straight line expense, regardless of whether you made them short-term and decided to keep them off the balance sheet. Again, this type of expedient is an accounting judgment, and you would want to communicate this early on with your auditors.